The day trading strategy that made you money in a bull market just won't work in a bear market. After over a decade of trading, one of the most profitable lessons I've learned is adjusting my trading strategy for different market environments. Now, before you look for a setup, open a position, or chase some trading idea you find on X, you need to know what type of market you're actually trading in. I think about this in two different layers. There's market regime and sector character. Market regime is the broader market environment. It answers a simple question. Is the market rewarding risk right now, or is it punishing risk? Or is it just giving mixed signals? And the thing that determines regime are pretty straightforward. Are credit spreads tightening or are they widening? Is liquidity improving or is it drying up? Are interest rates moving in a way that helps risk assets or pressures them? Is volatility calm or is it just starting to spike? And is the rally broad or is it basically just a few mega cap names holding up the entire market? A healthier, more bullish regime usually looks like credit spreads tightening, liquidity improving, rates pretty stable or falling in a constructive way, volatility coming down, and more stocks participating in the move. Now, a more defensive or bearish regime usually looks like the exact opposite. You have credit spreads widening, liquidity getting tighter, rates or the dollar pressure risk assets, volatility spikes, and market breadth gets weaker. That's when fewer stocks are making new highs, more stocks are breaking below key moving average levels, and the market becomes much more fragile. And chop is usually when those signals are mixed. Maybe volatility is elevated and breadth is weak, but the index is still holding up. Or rates are just moving around, liquidity is unclear, and different sectors are telling you different things. That's why you shouldn't think of regime as a price prediction. It's a read on the backdrop. Is the market broadly rewarding risk-taking, punishing risk-taking, or just giving you a bunch of conflicting signals? Then there's sector character, which tells us what the actual asset, market, or sector is doing on the chart. You determine sector character by looking at price structure first. Is the asset making higher highs and higher lows? That's an uptrend. Is it making lower highs and lower lows? That's a downtrend. Or is the price just bouncing between some support and resistance levels without real follow-through? That's chop. You can also confirm this with moving averages, volume, and failed breakouts. If moving averages are sloping in one direction and volume is confirming the move, that usually supports a real trend. If moving averages are flat, volume is inconsistent, and breakouts keep failing, that usually tells you the asset is stuck in chop. The easiest way to think about it is like this. Regime tells you the weather, character tells you how the specific asset or sector is driving through that weather. Now, market regime and sector character work together to help you understand what the broader market is doing and how the specific asset or sector you're trading is behaving inside of that market. Most of the time they influence each other, but they can also disconnect. And that disconnect is also really useful because it can tell you where relative strength or weakness is showing up. For example, you can have a neutral, broader market where the S&P 500 is mostly flat, but one sector like energy is trending higher, while another sector like healthcare is trending lower. That doesn't mean the whole market is collapsing. It means the broader market may be mixed, but underneath the surface, certain sectors are showing strength and other sectors are showing weakness. And that matters because your strategy should change based on what you're actually trading. Now, if the broader regime is neutral, but your sector is in a clean uptrend, you might still have a momentum setup. If the broader regime is neutral, but your sector is breaking down, you probably don't want to force longs there. So before picking a trading strategy, you need to diagnose both the broader market environment and the character of the specific asset or sector you're trading. Now, if a sector is popping like the recent AI trade, even though the broader market is pretty much sideways, then a strategy could be to swing trade or position trade the narrative. In this case, you really need to understand where a group of assets or even a single asset is in the narrative cycle, because sometimes the chart alone or even the market regime at that moment doesn't tell the full story. The easiest way to do this is by using our Rift Pulse tool, which we built for this exact type of analysis. You can access Rift Pulse at pulse.rift.ai and stay tuned for a separate video specifically on how to leverage the Pulse dashboard. Now that you know what type of market you're in, let's get into the different types of markets and the trading strategies to use. Now, traders love trending markets because they're also the easiest ones to understand. This is when the price is moving with clear direction up or down. In a real trend, price consistently respects the direction of the move. In an uptrend, pullbacks or temporary price dips tend to get bought. In a downtrend, bounces tend to get sold. Breakouts or breakdowns are more likely to follow through. Moving averages usually slope in the direction of the trend, and you don't need to nail every entry perfectly because the trend is doing the bulk of the work for you. In a trending market, trend following and momentum strategies make the most sense, like buying pullbacks when they hit a support level in an uptrend, looking at moving average crossovers like golden crosses and death crosses to help you spot trend directions, leveraging breakout or breakdown continuation strategies, and then using trailing stops so you don't close your position too early. A trending market is probably the friendliest environment for a retail trader because you're just following the direct market patterns. But a constant problem I see is when traders take this playbook and use it even when the market stops trending. And that's where things usually fall apart. Your trending market strategies are not going to work in chop, also known as ranging or sideways markets. This is when the market is moving, but it's not really going anywhere. Price keeps bouncing between support and resistance levels. Breakouts and momentum come and go quickly. This is where trend following strategies get absolutely murdered. Moving average crossovers trigger late, breakouts or breakdowns pull you in right before the reversal, and your stops keep getting hit over and over. I actually just published a video about the 5 foundational trading indicators, including how to read moving average crossovers in sideways markets. It's linked in the description for you to watch after. Now, long story short, in a sideways market, the strategy has to change. Instead of chasing capitulation or continuation, you're usually thinking more about a mean reversion strategy or an asset's historical long-term return. Now, for a mean reversion strategy, Bollinger Bands are actually very useful, where you're buying near support and selling near resistance. And of course, taking profits off the table faster instead of trying to let every trade run. The key thing here is that mean reversion works until the range breaks. So you need to pay really close attention in choppy markets and make sure to identify the level beforehand that will force you to change your strategy. This is also where automated grid bots can make a lot of sense, which I'll go into more in another video. A grid bot is basically saying, I don't know the exact next move, but I think this asset is going to keep bouncing around inside a range for a while. And if you know that you're the type of trader that may get impatient or emotional during these choppy times, a grid bot is a great way to stay active without constantly monitoring the charts. Now, the hardest type of market to trade in is a super volatile market, which is usually a very headline-driven market. Now, I know traders say they love volatility, and I've made a lot of money in these markets too, but a lot of times I see traders confuse volatility with opportunity. Just because something is moving a lot doesn't mean it's better to trade. A lot of the time it actually means the exact opposite. This is the environment where accounts get completely wiped because traders don't adjust their position sizing and they don't have enough discipline to set strict stop losses or take profits at a level that keeps your risk-reward ratio in check. In highly volatile markets, you'll see these huge candles, news-driven spikes, wider spreads, and indicators firing conflicting signals every few minutes. In this environment, the best strategy might be trading less, or at minimum reducing your position size. With a smaller position size, you can afford to use wider stops. Now, during these periods of high volatility, a great indicator to look at is ATR, or average true range, which factors in price volatility so you can set more realistic stops and prevent getting stopped out too early. I also covered this indicator in my last video, and I'll probably make an entire separate video on this because it's so important and so underutilized. Now, during these periods of high volatility, the name of the game is to manage your own risk and make sure that no single trade can ever end the game. Because these highly volatile markets are so difficult to trade, we built a lot of tools inside Rift to help traders, particularly during these tricky times. For example, you can set up automated stop losses and take profits with any new position, open or close positions based on signals, and for systematic strategies that are part of our autopilot feature, we set a maximum position size of no more than 10% of your portfolio value, so no one trade can ever completely wipe you out. During these highly volatile times, using automation and a more systematic way of trading can also be very helpful to just remove any emotion and FOMO from your decision-making process. Now, before I cover strategies for bear or downtrend markets, I do want to cover how I use signals and AI to choose the right strategy for different markets. You need to get good at understanding which signals actually matter in the market you're trading. Skipping this step will cost you, trust me. A signal by itself is not enough. You always want to look at your signals in combination with market regime and sector character. Now, once you have a sense of the broader market and sector health, then you're looking for confluence, meaning multiple indicators or signals are lining up and telling you the same thing instead of just relying on one isolated indicator. In a trending market, you might care more about moving average crossovers, breakout continuation, and momentum signals. In a choppy market, you might care more about support and resistance, RSI, stochastic, or mean reversion signals. Now, in a highly volatile market, you might care more about risk-off alerts and whether you even want to trade in the first place. Now, the hard part is that most traders don't have time to sit in front of charts all day, scan every sector, compare every asset, and actually figure out what's in play. And this is where AI becomes really useful. Now, I want to be clear. AI doesn't magically, predict the future, but it can compress a lot of the analysis you would already be doing into something you can actually understand quickly. Inside of Rift, we built two features for this: Market Scanner and Chart Analysis. The Market Scanner is basically your what's in play for the day. Instead of opening 50 charts and spending hours trying to find out where the action is, it just scans the market for you and surfaces the cleanest setups. Your top bull, top bear, assets on the move, assets showing divergence, basically the names that are actually worth paying attention to. Then once you find something interesting, you can go deeper with chart analysis. Now this is where Rift gives you a full trade readout, not just some, bullish or bearish label. It shows price trend, trend strength, volume, key levels to watch, and what would flip the setup bullish or bearish. And on top of that, it gives you the key drivers behind the move. Your technical drivers, market structure, order flow and positioning, relative strength versus peers, and any macro factor that might impact the trade. So instead of staring at a chart and trying to piece everything together from scratch, Rift helps you quickly understand the market environment, the signal, the setup, and what could invalidate the trade. The link to download Rift is in the description below. By the way, if you have signals in TradingView, import them into Rift. And if you don't have your own signals that you like, or you're not comfortable coding your own, you can just use Rift's pre-made signals or look at signals created by our community. Now, to start using someone else's signal, all you need to do is just tap subscribe, and now you can start automating trades based on that signal. Quickly, before I cover bear markets, I just want to say that as a long-term trader, I'm really excited about how AI is changing trading, and I'll cover in depth how to set up automation and leverage AI for fast technical analysis in an upcoming video. So if you haven't yet, subscribe. Now, during your trading career, downtrends and bear markets are unfortunately going to come up, and you need to be prepared for it. If I've learned anything in my decade of trading, it's that good traders know how to apply the right strategies to take advantage of down markets. Now, in my experience, this is great for long-term asset strategies. Now, if you're spot trading and after all your research, you still find yourself bullish on a specific asset or sector, this is a great time to dollar cost average or DCA into that asset. This could mean setting up a scheduled automated buy every week or month to increase your exposure in a different company or asset until the market starts to recover. Now, if you're trading futures and you notice that this is a sustained downtrend, this is the perfect time to open up a short position. Of course, always making sure you manage your leverage and position size accordingly. Now, if you're interested in trading futures or you just need a refresher on the strategies, I cover the key differences between traditional futures and perpetual futures, which I actually find a lot easier to trade in this video I've linked in the description. You might not want to hear this, but I have to be honest. For a lot of traders, especially if you're not confident in a given strategy, sitting in cash can be the best bear market strategy. Sometimes the edge is simply not forcing a trade and having enough patience to wait for character and regime to change before getting aggressive again. I've had to learn this lesson the hard way, and trust me, it was an expensive one. So if you take anything away from this video, it's that there is no one perfect trading strategy. There are strategies that fit certain market environments. Trend following works best when the market is actually trending. Grid bots or mean reversion can make sense in chop, but not in a one-way breakdown. High volatility requires smaller size and more trader restraint, and signals only really help when you understand the environment behind them. In order to succeed in any market, you need to diagnose the market first before you pick your strategy. Then use signals, AI, and risk tools to execute with more discipline. Thankfully, Rift can help you with all of it. So download Rift today and get started with your new trading strategy. Thanks for watching, and I'll see you in the next one.